What's going on out there? It's January 24th. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down headlines and tell you what's really moving these markets. I was going to start off with the Eagles, which I'll get to in a second, but taping this early in the day, market just opened. And it was kind of weird. I don't know if it's going to be a big story later. Probably not. But Exxon opened up down 7. Lilly was up 7. Wells Fargo was down 11%. McDonald was down 6%. They started halting stocks. They had a tech glitch. I don't know if they figured it out. I think they finally figured it out, but it's just weird. I'm hoping that it's not going to be a bigger story. I don't think I've ever seen that happen before with just a glitch in certain stocks. Not every stock, but it's usually like, oh, okay, we have a big glitch, whatever. But to see, be careful with those... just throwing those orders in the market because you might have got triggered and you might have got screwed today. It's going to be interesting when people talk about it later. But it might be nothing. It might be something. It was just something that's different that I have never seen before. And it looks like it's straightened out right now, but it's going to be interesting what they say about it later because I haven't really heard any excuses. Hopefully it's just a glitch or software patch. But it was a little crazy. Anyway, just wanted to start with that just in case it becomes a bigger story by the time you listen to this later on. But let's go Eagles. Took care of the Giants. And, the Giants I didn't think were a good team all year. I just thought the Eagles were better than them in every facet of the game. They kept it close last time. But, again, Eagles were coming out a little rusty. They kicked 5 field goals. If they had touchdowns, it would have blew them out. And this time they did have touchdowns. They had 4 touchdowns for the first 4 drives. They were up 28-0 and looked great in every aspect. Offense, defense. Hurts looked great passing. That was a question mark and running. But the running game in general, I think that's what separates them from the field and everybody else left in the playoffs. They can control the game running. And if you're going to load up that line to stop the run, they have 2 of the best wide receivers in the game and one of the best tight ends in the game. So they look really great on both sides of the board. Again, what's the Giants? I think they would have did the same thing in Minnesota. But now they're going to play the 49ers, who are also great. Although if Dak just had a decent game, the Cowboys would have won. They needed like Trent Dilfer, right? Someone who manages the game, doesn't make mistakes. And the interceptions he threw were terrible. It was just, it was really, really ugly. And he should have had more interceptions. He should have got a pick 6 when they got the ball about 2.5, 3 minutes left before they got stopped, punted, and never got the ball back. I don't know why I didn't go for 4th down. Just the mistakes that they were making. I don't know. It's got to be hard to be a Cowboy fan. They just, they have talent, but I thought they would do much, much better. They played good. It's just Dak didn't play good, right? That was a big thing. But they exposed the 49ers, right? They put a lot of pressure on Purdy, who's a rookie, wasn't used to getting sacked that much. They could have intercepted 2 passes, but, again, he didn't because Dallas dropped the ball on a couple of them. But they're going to patch those things up, right? They're going to patch those holes up heading into Philly. It should be a great, great game. On the other side, same thing with the Jags. They should have won that game if the Mahomes got hurt. And Mahomes just incredible quarterback. I love him. How don't you like him? You can't not like that guy. And I hope he's healthy. You want to beat teams at when they're the best. I'm a competitor. I never, if we were playing like in a championship game and somebody got hurt, I always wanted to play against the best player. No excuses. Team's healthy and everything. That's why I played. I wasn't like hoping someone got injured so we won. That's not the way. I don't think any competitive athlete really wants that. Even if you're a 49er Eagles fan, you win that game, you want to see Mahomes, 100%. You don't want to win with Mahomes like hopping around. And he went back out there, but yeah, his biggest asset by far is he makes his best plays when he's running around like crazy, right? And either way, I think it's going to be hard to beat Cincy. Cincy owns them, which, by the way, how the hell was Cincy underdog to the Bills by 5.5? I have no idea. I could see the 3 offensive linemen being hurt, but they stepped up, got good replacements. You're going to get the ball out quicker because you might not have that much time. They're the best wide receiving core. The defense playing great. They won, 7 or 8 in a row. But they control the Bills, basically beat the crap out of them. They didn't even have a shot. And look, the snow probably helped because you can't rush the quarterback as fast, which might have helped. So let's see. But they just look really good. These are the best 4 teams. You would say, well, the best 4 teams always make it. Not all the time. Sometimes you'll see an upset and it'll just it'll get really crazy and you're rooting for a team and then they get absolutely destroyed, kind of like TCU did when TCU won. Kind of wish Alabama was in there or TCU didn't beat Michigan because then you got a game that's over and after the first quarter. But all 4 of these teams are great. All of them could win the Super Bowl, and it should be an incredible little someday. So I have to talk about the Eagles, guys, just to start off. Wonderful, great, love it. They're going to be great for a long, long time because they got a lot of number 1 picks coming up, a lot of extra number 1 picks. So it should be really, really cool for them, and I'm hoping that they can continue to play the way they are because it is going to be a good game, and they're going to need their best game against the 49ers. Now, let's get to the markets, which keep going higher and higher and higher. NASDAQ now up 8% for the year. Most of the major indices are up, 5-6%. You go to Russell, S&P, the Dow Jones. I mean, everything's doing very, very well. Analysts, I'm watching the media because I make sure I pay attention to CNBC. I always have it open in the background, TV all day, because I like to hear some stories, but that's how you gauge sentiment of how everyone's talking about, all the analysts coming on. And I feel like everyone's super bullish. They say, it looks like we're going to have a soft landing. Earnings coming in better than estimates. Economic data is showing inflation is moderating, at least moving in the right direction. You're seeing lots of upgrades of big tech stocks, at least either upgrades of firms reiterating. I'm going to reiterate my strong buy on Microsoft, Google, Apple, AMD, Netflix. We're going to lower our estimates, but I'm going to reiterate why the stock price is going to go higher, even though I'm going to lower my estimates. But lots of optimism out there, and rightly so, with the market, having a good January, which is kind of normal when in bear markets to see markets move like this. It's really common. But here's what I see. And by the way, if you're a subscriber to one of our products, Curzio Venture Opportunities, it's like our flagship product, right? That's where I cover small caps and all my life. It's even stocks under 10 when I did it for Kramer. I did a low price newsletter, which I hated the low price name for Stansberry, and I had Porter. You guys saw that interview last week. Thank you so much. You got lots of great feedback. I mean, overwhelmingly positive, but some of it was a few things. People just, again, he's got a bold personality. Not everybody likes him, but, a couple lessons there is you never want to burn your bridges. I've never burnt a bridge. I'm friends with Kramer still. I could call him anytime and hang out with him. And, he's really cool. But, you never want to burn your bridges. And I never took things like that personal. For me, whenever I got laid off or I just looked at it as that was a great opportunity for me. And I wouldn't be doing this for you guys if that didn't happen. So it's good for them, good for me. I never took it personal unless they took it personal, but I never wanted to burn bridges because you could always go back to that and have lots of friends in the industry. Again, I focused on that for most of my career because I was very emotional when I was younger. And, again, I used to be really fat and be made fun of and all that stuff and playing basketball. And for me, I always looked at it like I'm going to destroy you. Instead of getting down on myself, I did everything I can to be the best and greater than everybody who actually had shit to talk about. And that's how I made my living even in this industry, right? So I just kept pushing forward and never took anything personal, but hopefully you guys like that interview. But for Curzio Venture Opportunities, small caps, that January issue is coming out later on today. I'm going to be breaking down all the data I'm about to share with you, much, much more in detail, though, along with a brand new small cap pick I think has incredible upside potential in this market. A name I've never talked about before is definitely not on most people's radar. And you're going to get that January issue again after the close today. But here's what I see. I see an incredibly dangerous market where the growth engine, right? This is how we grow. We got to grow earnings. We got to grow the markets. That's how you get higher multiples, right? The growth has been taken off the table. Okay, first with the Fed no longer keeping rates historically low, which we know. Again, I'm repeating this. I'm not going to tell you anything new for now. I'm going to get to a lot of good details in a minute. Which no one's really talking about. But instead of buying bonds, which is QE, quantitative easing, they're selling bonds, right? QT, or shrinking the balance sheet, which removes liquidity from the market. They're going to be selling hundreds of billions in treasuries, and to be technically correct, or letting them mature either way, but removing hundreds of billions of dollars off its balance sheet every quarter for probably another 6 to 8 quarters. Okay, you have this drag on the market. It's like you have, this rope around your chest and you're trying to run, and it keeps pulling you back, keeps pulling you back. Where at the end, you had someone when it was QE and low interest rates, every time you slowed up, you had two hands behind you pushing you forward to make sure you could still go forward, right? You used to buy stocks no matter what. They go down, who cares? Bad earnings are going to come back. Low interest rates, money's for free. It's a different market. So let's get back to growth, right? First with the Fed. That's removed now. They got to control inflation and no longer injecting money into the market. That's massive. Second, with China. China was also the main growth driver of the markets for decades. And people forget, China was growing in excess of 6% for basically 20 years plus, dating back to 2000. Sometimes 9. I think it actually had double-digit growth, but over 6% every year, dating back to 2000, pre-COVID. However, China is only expected to grow, 3% next year? Some economists see 4%. That's the big discount compared to 6%. But the 3 to 4%, this is what I have a problem with. Okay, one, it's still well below that 20-year average. But two, how is China going to grow that 3 to 4%? I want you to think about this for a minute. Because where do they see most of their growth from? I mean, the U.S. is expected to go into a recession this year with demands falling off a cliff due to much higher rates. I don't know if you saw the growth that's expected quarter after quarter, but I think it's like 0.2%, 0.1%, and then a negative and 0.1%. That's 4 quarters. We're not talking about 1%, 3%, minus 4%. No, this is like steady, very, very slow growth every single quarter for 2023. There's a shot that we can go 4 straight quarters of negative GDP. It's very, very likely that we could do that. And we're looking at, on average, a 0.2% growth per quarter over the next 4 quarters. That's what the economists are predicting. Now, the U.S. accounts for 20% of China's exports, not to mention that we're also doing everything in our power to be less reliant on China, right? We're moving investments, opening up new factories and fab plants in other Asian regions and in the U.S., trying to do less with China. How the hell is China going to grow that much when you're taking their biggest growth driver is going into a recession? Yes, they're opening, but it's not like it's going to be this massive 6%, even 3-4% growth. I mean, this is a super older population that's scared to death. They have bodies piling up like crazy, which is the saddest thing in the world because we know COVID is for real when it comes to older people, especially older people that have underlying conditions. There's nobody that doubts that. What we doubt is forcing this freaking needle and shots and everything else down the throats of children or people who really don't need it, which we now know was all bullshit. And the booster shots and the amount of profits that Pfizer make now finally admitted that, okay, it doesn't really, it doesn't prevent COVID, right? You didn't tell us that, right? You lied to us. It's okay, though. You've been in bed with the FDA for a long time. That's why you got fined so many different times. You have the leader, right? Someone who's basically on the board of directors of Pfizer, who's the main person that we're listened to, which is Gottlieb, right? I mean, if that's not the biggest bias ever, that's freaking crazy. Now we know a lot of this bullshit. However, in China, COVID is very, very serious. I mean, bodies are piling up. This impacts a lot of their population because this is a much, much older population. They're not just going to run out and go to work and everyone's going to be fine. They're seeing this. It's like September 11th when that happened. Everyone's like, "Oh, where were you? Where were you?" Remember when they shut down all the airlines and, again, all the flights were grounded and they did it for a couple of days. When they opened up, people, even myself, were looking outside. You're thinking like an airplane's going to crash into something near you. That's how scared you were. That's how you're thinking. That's your mind going, holy shit, when something dramatic happens. These people are seeing their grandparents, parents dying from COVID. They're not going to run out really quick. It's very, very scary over there. But I don't see China growing 3 to 4% when you're taking out their main growth driver, which is the U.S., which is going to go in a recession, and has announced their intentions to lower their investments in China, which we're doing right now. So I don't see China becoming a major driver for U.S. growth for a long time, and that's what's driving this market. In the meantime, what do we see? The Fed just raised rates, continues to raise rates, fastest pace since the Fed ever. And maybe believe, hey, you know what? The Fed's close to done. They're close to done, the Fed. You got a couple of more hikes until March. Terminal rate at 5, maybe 5.25. I got to say, really? Because I'm a person, you have to look at the data, right? And I'm someone that looks at the data constantly. And I'm going to share something which I'm not seeing being shared anyplace else, really. I'm not saying that as this whole, so you pay attention more. Just listen. Listen to what I'm saying here. It's very, very important. Because I'm going to make a bold prediction that we may see another 50 basis point hike in the future this year, or a lot more 25 basis point hikes than are projected. I'm talking about through the second quarter and maybe into the third quarter, which nobody is predicting. We're looking at March, maybe April, some of looking at a 5.5% terminal rate. We could be well over 6%. You say, Frank, that's crazy. Hear me out. Hear me out first before you start yelling and cursing at me. You look at the Fed, they said they're not going to pause until they assure inflation's under control and we're near its historical 2% rate. Right? And one thing's for certain, over the past 8-9 months, you got to believe the Fed. They did everything that they said they were going to do. Whether you agree with it or not, whether you hate the Fed or whatever, exactly to a T, they've been doing everything. I told you they're going to raise aggressively. You knew the rate hike. Like, there's no surprises. There has been no surprises in terms of rate hikes. There's surprises in how they're speaking, and sometimes it's getting misinterpreted, and that could be their fault. But every single hike, I mean, it's predicted right on the button, and this is what they've been doing. They said, okay, we're going to slow the rate of these hikes, or the percentage, which they did. They're still raising, but they slowed to 25 basis points, and that's what they said they're going to do. Now, they want to get that rate closer to 2%, which is going to be very difficult. So as much as everything's trending in the right direction, CPI is still at 6% right now, which is insane. If it didn't go to 9, 10%, and it was at 6%, we'd be in panic mode right now. But since we saw 9%, now it's 6%, we're like, wow, it's trending in the right direction, so everything's fine. You're right. Okay, and even when you look at other things, I mean, things are declining, retail sales pulled back, even the PPI, most inflation gauges have showed that we're moderating. But let's look at the present. Have you seen what gasoline prices are right now? They're up 20% from the November lows. So the average price right now is $3.60. We have to look at everything pre-COVID, of where the market was pre-COVID. Because after COVID, everything was crazy. We saw 1 month of a decline in the markets before the Fed said, hey, let's just keep printing as much money as we can. It doesn't matter. It's not a limit. There's no accountability. Let's keep going. 1 trillion, 3 trillion, 7 trillion. They got to $11.5 trillion. Now we're removing all that liquidity from the markets. That's why everyone's laying off, seeing slow demand, much higher rates. So we have to go to a pre-COVID market, right? Let's eliminate COVID because that's a good comparison, because that's where we're going to be, removing this liquidity. So we look at gasoline prices on $3.60 on average, right? So pre-COVID, that's the highest gasoline prices have averaged. And I went back on an annual basis pre-1993 at $3.60. So I know the guys are watching are going to be like, they were $5 at $3.60. You guys could afford it. It's not a big, it's $3.60. Do you see them going lower? I don't know. I mean, it's nice when you have this massive strategic oil reserve that you just, unloading, and now you're going to have to replenish it. But it's interesting because now oil prices are going up over $80 a barrel again. Let's go back to pre-COVID. I know we saw over $100 a barrel. COVID, oh my God, we saw 0 and over 100 in like a year and a half, right, for oil with the futures. But pre-COVID, the last time we averaged $70 a barrel was 2013. So you go from 2013 into, the end of 2019, beginning of 2020, oil prices, I mean, they never even got above $70, the average. We're over 80 right now. Have you seen what copper prices are? They surged. They're 420. It was 320 in July. 8-month highs. Remember that crash in used cars? Used cars are falling. They're crashing. We never seen anything great. Everything's working. That's 6 straight months of declines. Well, let's look at the present. So according to the Manheim Used Vehicle Index, okay, this is the most accurately, widely used gauge in this industry when it comes to used cars. Used cars increased by 1.5% for the first half, at least the price first half of January, which currently marks the second month in a row that used vehicle prices are rising. Did you know that? Did you know used vehicle prices have been rising the last 2 months? Did you see what copper prices are? Do you see what natural gas prices are? The Fed's trying to control inflation right now. We're looking at a market that's surging, which is giving them okay to continue, but now you're seeing inflation start to come back. Have you seen food prices? Look at the dining index. This is according to Open Table, that seated index, which a lot of people use. I'm not just picking out components. This is what people base this stuff on. Most popular gauges. Right? So you're looking at the Open Table seated index with dining, and dining is starting to surge again. The prices. Also, supermarket prices are starting to surge again. So you're looking at food prices going up, oil prices going up, energy prices going up, copper going up. Remember, rent's coming down? That was a big thing. Rent's coming down. It's the biggest component. Jeremy Siegel, well, we're looking at real-time data, and rents are coming down if you're looking at real-time data. I want to see what he says next time he's on TV. Because Zillow Rent Index, again, another measure that people that, widely used gauge. The Zillow Rent Index rose in December. And this is falling off its highs from July, where we saw, again, trending in the right direction. We're no longer trending in the right direction. And then we have the wonderful stock market with the most risky assets, which includes the NASDAQ. NASDAQ's up 8% this year. Those heavily shorted names are up tremendously. And what do you think the Fed's going to do? The Fed can't say, hey, the next meeting, where's CPI going to be? I mean, all these things are broken out. You may see energy, energy is going to be higher. Food prices are going to be higher. Maybe you see rentals, again, they should be higher. Maybe, again, it's back-looking data, so maybe you're going to see it lower. But what the Fed is seeing right now is not an indication that they're going to stop anytime soon. They can't. Because inflation is not just, it moderates. It's going up sharply. Sharply. I mean, so now we have an insight. Why is that happening? If you want to look at what all this is related to, it's related to one thing. It's the dollar. The dollar's falling. That's why gold's going higher. That's why stocks going higher. Everything's good. But when the dollar falls, inflation goes through the roof again. So this is a double-edged sword that the Fed has. I mean, there's no easy solution here. Either the Fed's going to keep raising because we're seeing this inflation surge, or we're going to see the markets come down tremendously and everything come down and really, really crash from here. Because that's what the Fed needs to see. Because we have no growth going forward, yet stock prices are going higher. So the NASDAQ up 8% this year. At the same time, the major tech companies are doing what? They're laying off tens of thousands of employees. Every one of them. Go through them. Every one of them. Tens of thousands of employees. Maybe it's 2% of our workforce. Maybe it's 6% of our workforce. Some of it's 12% of our workforce. But they're laying off all these employees. And by the way, getting back to earnings, those earnings, when everyone said, oh, they're beating estimates, and I've mentioned this before, they've been revised by an incredible 7% plus lower over the past 3 months heading into this quarter. I've never seen a revision that much other than black swan events like COVID or the credit crisis, where we didn't know the full extent of the damage. In 2008, by the way, which I'll show to Curzio Venture Opportunity subscribers, wait till you see the market moves from October into the final lows in 2009. So October 2008, we kind of bottomed. The market went up around 16%, then came down, then went up like 30% from its lows. Or over 20%, 25% from its lows, before it crashed completely and hit the absolute low in March. So what we're seeing here is normal within the bear market. So now you're seeing earnings come in ahead of estimates, but the estimates have been revised sharply lower. And to make matters worse, even with the companies reporting, I mean, today, let's talk about the companies reporting. And outside of oil, energy, those companies, Halliburton, good numbers, solid numbers. You see natural gas, energy companies reporting solid numbers, talking about giving more capital back, right? Because they're printing money right now. Even with oil at 70, they were printing money at 80, 90. It looks like oil continues to trend higher. But let's talk about some of the other companies like GE, Verizon, 3M, all guided down for 2023. So when I look at earnings, the S&P 500 is expected to generate around $230 in earnings per share in 2023. That's all the earnings for all the S&P companies combined. It's a very important number you need to understand. Because that number was 160 at the peak pre-COVID in 2019, which is the full year 2019, so January 2020, that number. Now they're all up to 240. There's still 230. How are we going to predict? They're lowering estimates. How are we going to get to 230? And I had this number at 180, at 190, which is a significant decrease from where this is. And you may be like, Frank, you're nuts. But you know what? Let's go with someone who's been predicting this market for a while, for a very, very long time. Because it's in line with the bearish case of Morgan Stanley with Mike Wilson. Again, dead right on this market for the past few years. He just tweeted this. I think it was like a day ago. And I'm quoting him here. He goes, our work shows further erosion in earnings, with the gap between our model and the forward estimates as wide as it's ever been. The last 2 times our model was this far below consensus, the S&P 500 fell by 34% and 49%. Pretty scary. And I went back and looked at their earnings predictions. These guys have a great track record for predicting forward earnings. If you go back all the way to 2000, they have a chart of it, and they're pretty close within the guidelines. And they have that chart compared to what was really reported, and they're pretty much within that range. Right now, they're more than 30% off from their earnings compared to what's expected in 2023. 30%. Holy shit. So what do we have? We have a market that's surging while earnings are coming down sharply, meaning that the market's getting more and more expensive, right? The market can go up 300%. If earnings go up 500%, you're still going to have a cheap market. It's all about earnings, right? In relation to price divided by earnings. But you have the price going higher and the earnings going lower. Look out. Because if you're looking at the NASDAQ right now, it's trading at 27 times forward earnings. I think the highest it ever traded was 40 times earnings, I think, during the dot-com era. But if you want to put the 27 times in forward earnings in perspective, if you look at the 10 years, again, pre-COVID, right, which is the market that we were in, and remember, that market was with rates at 0, Fed in QE mode, quantitative easing, the average PE for the NASDAQ was 18. We're at 27 right now, heading into a recession, rates at the highest level since the 80s, Inflation's still high and going higher now, inflation, in so many key categories, which affects consumers. This is food prices, this is energy prices, this is gasoline prices. These affect consumers directly, who are already shrinking their wallets and starting to spend less. Who already you're seeing credit cards go up tremendously, along with what these banks are doing. They're raising the credit card rate. They're not raising your savings rate, though. Isn't that amazing? I gotta love the fucking banks. Anyway, in the middle of this, right, heading into recession, rates highest levels in decades, inflation still high, while every major tech firm is laying off tens of thousands of employees, and you have to ask yourself, why now? And this is over the past week and a half. All the major ones. You look at Microsoft, I'm pretty sure Apple did. You had Google announced recently. And Netflix announced a little while ago. They're doing a little bit better. The stock price is doing better, starting to surge again. I think it's way, way well ahead of itself. But when you see all these companies laying off employees, ask yourself, why? Right? Why are they laying off these employees, which in a tech sector, I don't think they've done since the dot-com era. I don't even remember 2008, 2009, them laying off a ton, which they probably did. I just don't remember as much. But there's a reason why they all have special letters going out to the employees apologizing. It's our fault for the layoffs. You don't see that ever. You don't see that from other companies. Like, they don't. You might see an eternal letter here or there, but every letter, like Spotify's letters out there, Google's letters out there from the CEO, the Microsoft letters out there. Oh, we're sorry. And you don't see that because they're not used to doing this. They're not used to laying off employees. But why are they doing it right now? Because the only way you would be laying off employees right now is if you see the future growth is going to come down tremendously. They're telling you that. Otherwise, if they really believe that this is real and NASDAQ's coming back, we're back, we see the economy getting better, they wouldn't be laying off employees right now. So bringing this all together, what does it mean? Be careful here. Don't get sucked in. We've been talking about buying puts, and I love it. You know why? Because right now, when you have puts, and you're buying long-dated puts, and you're taking a position, and I said, around 5% of your portfolio. So if the NASDAQ goes up 30%, big deal. You lose 5% of your portfolio. Every other stock's up tremendously. You're up tremendously. However, if the NASDAQ does crash, that 5% portfolio, that put can go up 3x, 5x, and go tremendously. That's why you need that strategy. It's very important. You might be looking at going, the market's going up. The market's going up. Your portfolio's doing fine. Your long positions are doing fine. You're doing great. Who cares? You're not shorting the markets here. You're only losing the amount of money you put into that put. That strategy works when you have, it's not just a market coming down, it's an incredibly volatile market that goes all the way up, comes all the way back down, all the way up, comes all the way back down. And that's what we're seeing. And we're going to continue to see that as long as the Fed continues raising rates and even pauses. Because if you think in 2023 that they're going to lower rates, you're out of your mind. The only way they're lowering rates is if the market crashes 30% from here and everything, prices fall off and unemployment goes well above 6%, 7% even. That's when things change. That's when the Fed might be like, okay, we're ready. Right now, the market's surging. Like, the Fed is trying to control inflation in the face of the market up 8% in 3 weeks. Risky assets up probably 15, 20%. In the face of earnings coming down sharply, layoffs, more layoffs. And we're expected growth where? Of 0.2% on average for every quarter on average through 2023. I mean, those could simply, easily be negative, which are basically negative. Who cares if you grow 0.01% for quarter? It's a recession. Is that much different from negative 0.1%? No, but it is a recession. Just not defined, which is, again, it's not even defined as 2 straight quarters of negative GDP anymore. It's not. We changed definition last year when we lied about the jobs number, right? We're adding 1 million jobs numbers, 1.2 million. We're fine. I don't care about GDP. It doesn't matter. This is a different definition. And yes, it's because elections coming up in 4 or 5 months. Yes. And now we just figured out that those million, they grew 10,000 instead of 1.1, 1.2 million. We only grew 10,000. The revision by the Philly Fed, not by some idiot, not by some person who's just out there trying to make. This is by the Philly Fed revising those estimates. Say, hey, they might have been calculated wrong. What do you think is going to happen with that jobs number when we calculate the third quarter and then the fourth quarter, which is going to be coming in the months ahead? They're going to be revised a lot lower. So be careful here. It's not a time to be super optimistic. It's time to be very, very cautious. When you see slower growth and stocks are still going higher, you need to be careful here. I know it's tough because in your head, you're watching TV and you're seeing the market go higher, you think you're missing it. Be very, very, very careful. The markets and that pendulum swings a lot to the other side before it comes back. Meaning you're going to see the markets go up a lot higher than you think and go a lot lower than you think. Right now, they're going up a lot higher than you think. And maybe it continues and you see a little short covering because people were betting that the market's going to come down. But what I see for technology, what I see for risky assets, what I see right now when there's no growth in the market right now, and the Fed's not going to be there to bail your ass out like they were for the last 12 years, be careful. Protect yourselves. I give a shit. Okay, yes, I hope the market goes up 30, 40% from here. Big deal. You lose a little money on some of those puts. Big deal. You're doing great in your portfolio. This is a forecast I hope I'm freaking dead wrong on, I swear. I hope I'm dead wrong on it. But I don't think I'm going to be. I've been doing this for a long time, and it's very, very scary out here. And I don't see a lot of people on TV telling you and highlighting how scary it is. But when you see these numbers go up, go back, and I'll cover this in Curzio Venture. Again, Curzio Venture Opportunity, that newsletter, which is the January newsletter, I'm going to be covering a lot of these numbers in much more detail. I'm also going to be showing you a great name that's ripe to surge in this crazy volatile market. But I'm going to break everything down in that newsletter and what you're going to see over the next 12 to 24 months. Because when you see earnings going lower while stock prices are going higher, it's a very, very dangerous recipe. Okay. I've seen it before. If you look at 2008, again, I'll say this because of research opportunity, I'll cover it a little bit more. But if you look at 2008, look at the periods when you get a chance. You can't really see them too much because it goes so far back. So you need like a certain charting system. This way you can really put in the right dates. But if you look at the second half of 2008 to the absolute low in mid-March, I think it was March 12th, 2009. In that, we had a 16% move higher, a booming 25% move higher, before we absolutely crashed from those lows. And the higher we go, the more risk we have in this market, especially with the Fed continuing to raise rates, inflation starting to reverse and go higher. Just protect yourselves. Again, I hope I'm wrong. You protect yourselves because by buying puts, you're only going to lose the money that you put into that put. However, and if the markets go higher, you're fine. But by protecting yourself, the markets do come down. That 5% can represent 30, 40% of your portfolio, because that's how much that put can go up if you're right, if you're betting against the right things. Again, it's a very good strategy in the market. You need to be very, very careful, and that's what I'm seeing. So that's it for me. Tomorrow, I'll be covering in a lot of great stuff with the one and only Daniel Creech, covering the markets, including Microsoft's earnings, which, by the way, there's no way Microsoft could blow out those numbers tomorrow. You know that, right? There's absolutely no way. If Microsoft blows out those numbers, pushback they're going to see. I mean, you just laid off 10,000 employees. Imagine blowing out those numbers. And I mean, what are those employees going to say? Hey, your earnings are freaking great, right? So they're going to probably report in line to a little weak estimates. But just from a political standpoint, man, if you're laying off employees, you better not blow out those numbers unless you're going to have a big freaking target on you. So it's going to be interesting to see what they report and the revision. So they might report numbers of, hey, these are good, but this is what we see in the future. And I expect those estimates to come down. They have to come down or you wouldn't be laying off employees. There's no way you could report. You can't lay off 10,000 employees the week before you report and then report fantastic numbers and raise those numbers next year. That ain't going to float well, especially in this market. And man, you want people protesting outside, that's the way to do it. But Dan and I will be covering those numbers tomorrow morning. A lot of big companies still set to report. We're probably in the third inning of earnings. Got a lot more to go. And we'll be sure to break everything to you as soon as it happens. So guys, that's it for me. Questions, comments, for the email frank@curzioresearch.com. That's frank@curzioresearch.com. Let's go Eagles. I'll see you guys tomorrow. Take care.